Okay, here we go. Hello, and welcome back to the Nadlan Forum Podcast Daily. I'm Ruby, and as always, I'm here with Lior. Today, we're tackling something that honestly feels a bit upside down to a lot of buyers out there. Record home profits, even while mortgage rates are, well, pretty high. Lior, get this. The average US home seller just made nearly a 50% profit in the third quarter of 2025. Not at the wild pandemic peak, but still 49.9%. That's not bad, mate.
Yeah, Ruby, it's honestly kind of crazy when you say it like that. I see people in my New York circles almost in disbelief that with affordability getting squeezed and rates higher, profit margins can stay so elevated. But there it is, $370,000 median home prices, up another 3.4% year over year. Sellers cashing out, still, with the average profit per sale over $123,000. Even if we're down a bit from the absolute highs of 2022.
And it seems like it's inventory, right? Not so much some wild demand boom, but just not enough homes for the folks who still need or want to buy. If you're selling, you're in a pretty cushy spot. Actually, I have to jump in with this. My family friend in Melbourne was waiting like 2 years for the perfect time to sell her investment place. She thought she was going to cash out big like in the States. And let's just say that Melbourne market isn't handing out 50% margins. Makes you wonder, Lior, why does the US housing market just keep bouncing back?
Yeah, and that's a great point, Ruby. The resilience here comes down to a supply squeeze, really. Sellers are holding tight. Inventory stays limited. So even when affordability is tough and rates spiked post-pandemic, prices don't fall much. What's even more fascinating to me is you look just a decade ago, margins were around 30%. Now they hover close to 50% for nearly a year straight. It's not only supply, but also demand sticking around because people have life events, families grow, jobs change. There's always movement somewhere, even if it's not across the board.
And I have to admit, as we covered in that Rethinking the American Dream episode, a lot of folks can't really make the numbers work to buy right now. But those who can, still out there, still buying, which is enough to keep those profits up for sellers. And until home builders actually ramp things up, I don't see the supply side getting much looser anytime soon.
Exactly. And builders are just not keeping up, especially for that mid-range family housing. So the people who own now, they have all the leverage. Any modest bump in demand just pushes prices up more. So these high profit margins, they could stick around unless something big changes on inventory or rates.
Let's zoom in a bit, because honestly, looking at the US as this one uniform market is just not how things work. If you check the latest numbers, there's a real split. 58% of metro areas actually saw their profit margins drop just from last quarter, and over 80% dropped year over year. Yet the national headline looks strong. Weird, right?
Oh, absolutely. And it's particularly dramatic in places that were rocket ships during the pandemic. Ocala, Florida. Profit margins fell from over 100% last year down to 55%. Vallejo, California, same story, down to the low 40s. It's like those huge surges can't keep going forever. And Ruby, I talk to New Yorkers every week, and so many are looking to invest somewhere, anywhere, with better yields. But these old hotspots aren't the slam dunks they were.
Totally. Meanwhile, did you see the jumps in the smaller, more affordable metros? St. George, Utah went from 26% profit up to 37%. Dayton, Ohio climbed to over 60%. It's that post-pandemic migration wave, right? People bailing out of coastal cities looking for value. Suddenly, places no one talked about are cash cows for sellers.
Yeah, it's the reshuffling. I mean, if you wanted to buy in New York or San Francisco 5 years ago, the idea of moving to Kentucky or Ohio wasn't on the radar. Now, with remote work and budget-conscious buyers, they're fueling those new regional booms. One thing though, If you're thinking as an investor from New York, you can't just chase the old headlines. Things flipped pretty fast.
I might be wrong, but doesn't it kind of remind you of chasing tech stocks after they've already gone bananas? By the time the headlines are shouting about Ocala or Vallejo, the big money's already been made, and then, bam, it gets a haircut. But these smaller markets, they're sort of like emerging markets in real estate, you know?
Yep, and it's a good lesson. Look beyond the obvious. Migration is changing the game, especially where homes are still affordable. That's where profit margins are quietly growing, while some former stars are running out of steam. Investors just need to track the data, not the gossip.
And that data shift matters. If our listeners missed the last few episodes, we talked a lot about how affordability and migration are redefining the winners in this market, not just the usual suspects on the coast.
So, Ruby, let's get into what's truly fueling all this. Nobody's moving. The average homeowner now keeps a place for 8.4 years. That's the longest in at least 25 years, and it's getting longer each quarter. This so-called rate lock-in is real. People got used to their 2.7% or 3% 30-year mortgage. Why would you sell and jump into a 7% rate? I wouldn't.
Right? I mean, back home in Australia, turnover's way faster. In the cities, you see homes up for sale all the time, people leapfrogging up the ladder. Here, people find a rate they like and they just hunker down. The only folks selling are the ones who absolutely have to. Divorce, job move, life stuff. And that means fewer homes hitting the market, prices keep inching up, and sellers, again, get all the power.
And look, distressed sales, those bank-owned bargains, are tiny. Just over 1% of all sales. That tells you even if some folks are struggling, most homeowners are in a solid spot financially. I remember when I first moved here from Tel Aviv, turnarounds were much faster. Israelis buy and sell quick. Sometimes just to beat the next jump in price. Sometimes for just, opportunity. Here, it's almost like everyone's frozen unless the market offers up a no-brainer deal.
Do you reckon this rate lock-in is here to stay? Like, will we see a return to normal turnover if or when rates finally drift down? Or have people just shifted to this hold forever mindset now?
Good question. I think if rates drop enough, you'll see a wave. Maybe not back to the old normal, but a release of that pent-up supply. But if the last decade taught us anything, it's that once habits change, it doesn't just snap back. Some homeowners might hold on tight even as rates ease, just because stability feels safer. Especially if prices keep going up with low supply. Honestly, why sell?
Yeah, so bottom line, tight inventory, long tenure, and a healthy homeowner base means prices have this natural support, even with buyers struggling on affordability. Unless something major shifts with supply or rates, I reckon sellers will keep holding the cards for a while longer.
Totally agree. And hey, to our listeners, if you want to know how this impacts your own investments or you're considering buying, just keep watching the market, be patient, and wait for those moments of opportunity.
All right, that's where we're leaving it for today. Thanks for tuning in to Nadlan Forum Podcast Daily. We'll be back soon to dig even deeper. So, Lior, thanks, mate. Always fun debating with you.
Thank you, Ruby. Always a pleasure. Everyone, take care and catch us again soon.